Hey folks, welcome to a weekend edition of Market Correction Analysis by InTheMoneyStocks.com for August 11, 2007. Well, I usually don't do weekend updates for you guys, but there's some stuff I really want to get into, and it's frustrating me, and last night, going to bed, I thought about it over and over again, and this morning I just couldn't get it out of my head. And there's some really deep issues here that are bothering me about this market. And not just about the market, but about the Fed as well, and what's been going on in the market out there, whether it's subprime, mortgage lenders, and all that junk. Alright, so I want to talk a little bit about what happened on Friday. The Federal Reserve infused the market with $38 billion in cash. Alright? They basically bought up a lot of this subprime, this credit that has been troubled lately, in an attempt to assure the market that they're there for the market just in case. This is what bothers me about this, folks, and I'm going to kind of go off on a tangent here. We're going to do some technical analysis this weekend on this weekend edition, but I'm also just going to talk, and so bear with me, guys. Alright? When you add money to any economy, what's it doing? Alright? It's our dollars. They're adding money to the economy. That's making our individual dollars worth less. In the long run, it's making goods cost more, because when our dollars cost less, it takes more of those dollars to buy up goods. So in the long run, if they are adding money to this economy, they're going to cause inflation. That's exactly what inflation is. So this is what bothers me in addition, guys. Not only is it our money going to be worth less, but they're using our tax dollars. Does this bother anyone? That they're using our tax dollars to bail out subprime lenders here for making stupid loans? Alright? It's enough that we have huge amounts of debt in this economy. Alright, we're basically as a country broke. And I hope everyone understands that. We have tens of trillions in debt that we owe other countries from our bonds that we're never going to be able to pay back. Let's be honest here, folks. We have a medical system in shambles, social security system in shambles, and here we have trillions and trillions of debt that we owe the world. Not only so, and they're using our tax dollars to basically bail out people, or lenders, if you would. That bothers me a lot here, guys, and that's one of the biggest things here. How can they do that? Where in the Constitution does it say that when someone gets in trouble for doing something stupid, that the government needs to come to the rescue? Real markets work in ways that are correct. When you let a market, and this is me speaking as an economist now, when you let the markets do what they do, it automatically corrects for it, guys. Alright, it's only when the government feels like it has to stick its hand in something that it really screws up. And yes, people are going to get hurt here. Alright? No one says that this subprime issue isn't going to hurt people, and it sucks. It absolutely sucks. But it's not right for the government to step in here and use our hard-earned tax dollars to bail out lenders and creditors. Alright? The additional thing I want to point out here, so if they bail out these guys, let's say I have my 401k or my stock account, and in the market, let's say I hypothetically lose 20%. Is the government now going to come in and give me back some of my money because, oh crap, I made some wrong decisions on investing too overzealously in maybe foreign markets or maybe some small caps? No, they shouldn't, and they probably won't. So my point here, folks, is that come on, man, let's stay out of this. If the Fed cuts rates, it's going to cause inflation because again, the dollar will weaken. If they add money to the system by an additional too much money here, it's going to cause the system to cause inflation as well. All right, and the dollar to weaken. All right. Now, what I do want to point out here is that in the near term, when the government or the Fed intervenes in the market, it could keep the market afloat here. All right. And this is what I want to show you guys. This is the daily chart of the Nasdaq. All right. The daily chart's right here. You see the wave 1 down. You see wave 2 down, 2 up. And now this should be the start of wave 3. But notice we had a double bottom here on the Nasdaq. Came down twice, touched the 200 basically. With the Fed coming in, they caused the markets to rally a little on Friday by giving the market confidence that the Fed wasn't just going to step back and let the whole debacle happen. Alright? So what you're looking for here, guys, is in the daily chart, this is somewhat of a bullish candle on the Nasdaq. Alright? So it's key to remember here that with the intervening, we could pause above this 200 before continuing down. Now, it won't be a long pause, and we are going to go lower, but I want everyone to be aware of that this could be a pause, maybe a small push up, before we boom right down through this 200. And by the way, guys, when we go through this 200, we're going to March lows. Alright, on the Nasdaq and on the SPY. And I want to show you this, alright? On the SPY, this is the SPY, alright? This is the daily on the SPY. Notice we are technically below the 200, but we are doing another double bottom here. You had a double bottom here, and another push down. We touched those lows, and the Fed saved us. Now, what I want to show you is this, and explain this, guys. when you look at the markets, you look at time frames. We're looking at the daily time frame here, but you also need to look at bigger time frames to see bigger moves. On the daily, we show we could have a bounce here based on the technicals of this candle. Alright, a small bounce up, possibly here. But now let's look at the weekly chart and find out what the weekly tells us, and this is what I really want to harp in on. On the weekly, we're not that bullish, alright? What we are sitting here on the 50 moving average, double bottom on the 50 moving average on the weekly. And what I do want to show is as soon as this breaks on the weekly, which it will, alright, as soon as it breaks on the weekly, this is the weekly support right now, alright, and this is the SPY. So follow the SPY. The first day or the first week we close below this line right here, which is the 50 moving average major support. We're going right to here, which is March lows, as I just said on the NASDAQ chart as well. Alright folks, so you're going to see a drop of this amount down. Then once we get here, guys, alright, and we will reach some other support points along the way, but this is ultimately where we're going to go. We're going to have some major support right here, alright? A lot of people will come into the market and support the market there. Alright folks, after that we'll have to reevaluate to see if we're going lower, alright? We do think that we might be going lower as well once this is all washed out. Alright folks, and what I also do want to talk about now a little bit, here again is something I'm going to show you guys in a minute, but before we get into that, I want to just talk to you guys about how we're not saying that the end of the world is coming here, guys. This is a normal correction that needs to take place. The credit issues are very bad, and that's what's going to cause us to drop more here from where we are in the markets. But basically, or ultimately, once we do reach a bottom, we should have a nice bull market come back in, you know, and a big move up, and we think that we're going to see a move up through the Chinese Olympics, alright? The Chinese Olympics, it's causing huge amounts of growth over there, and again, we're a world economy now. So when the rest of the world is going strong, anything that has any tangents outside of the United States is going to do very well, and in turn, the United States should continue to do well. We just have to deal with these housing issues and credit issues. Then things will come back in. The idea being here is if we can time this correctly, we can have a great buying opportunity, alright? Through the Chinese Olympics, which is in basically till the end of 2008 and early 2009, and then we'll have to reevaluate, folks, alright? So wait for the washout, then look to move back in here. Once we get through this low, at least do not enter above this low, alright? You don't want to enter up here because you are going to get a little pullback. Alright, I want to also talk about something interesting here that we've talked about a little bit before. It's the mortgage arms, and I want to tell you guys or show you guys how this has canceled out the Fed. And this is really interesting. Bernanke and Greenspan raised rates over the course of quite a few months, up to 5.25% where we sit now. Now, what's so unique here, guys, is that the mortgage industry basically negated all those interest rate hikes, and let me show you how. The mortgage arms, the arms which basically locked in your what you're paying in interest at a low price or at a low rate for a few years, basically negated the whole idea of the Fed raising rates, and that's why we're having such problems now, is because all of a sudden you basically cancel out the Fed for 2 years of rate hikes by keeping these arms locked in at a micro percentage of what they should be at, and then all of a sudden now we're seeing these things readjust, and they're readjusting up as if the Fed overnight raised rates 3%, 4%, whatever it would be. And that's why this is such an issue now, guys. And this is the mortgage industry. The mortgage industry created this, alright? Now, I happen to think the Fed should have been wiser about this, and the government should have been wiser, and they always seem to act too late in this, but you can't do that. You got to understand, when the Fed's raising rates, there's a reason for that, and by these mortgage companies luring in, you know, these subprime borrowers and understanding what's going to go on, they basically created this. So again, I am against a bailout. You cannot bail out this. You got to let it wash out. It's not fair to the rest of the economy or the rest of the population to bail out these guys just because they did stupid things. And lastly, I want to just draw everyone's attention to a hot sector report we did on our website, inthemoneystocks.com, and this is going back to May, I believe. And in this hot sector report, we wrote something interesting. This is May 19th. In this hot sector report, we will look at what is to refer to as the market stocks. Specifically, Goldman is known for being the market. When it is up, the market's up. When it's down, the market's down. We analyze these stocks using our proprietary indicators and various other technical indicators. We then expanded the charts to the weekly and the 2-year. When looking at this longer time period, we found negative divergences everywhere. Alright, folks, look at Goldman here. When we brought it to everyone's attention, $230. Alright, when we looked at JP Morgan, alright, we looked at $53. And when we looked at Merrill Lynch, we looked at $95, $96. Alright, I just want to point out where these stocks are trading now. Goldman on the daily here, and this is the weekly, but you guys can imagine on the daily, Goldman is down to 180, JP Morgan down to 44, and Merrill Lynch down to 74. You're talking about 20% declines here. We were calling a short back in May on these based on negative divergences in the charts, and they sure came to fruition. The last thing I'm going to leave you with, guys, is something on the weekend here, which is trading. Either swing trading or day trading isn't about trading stocks in the market as much as trading emotion and human psychology. Think about that. Think about how contrarian I am as a player in this market, and you'll understand. Take care, guys. We'll talk Monday.